Good day to all my fellow investors. Even in this bear market, I find it challenging to uncover enduring enterprises not still trading at a premium despite all the steep price drops we have seen. Nevertheless, Pfizer, the pharmaceutical giant, seems to present a rare quality value investing idea. Pfizer discovers, develops, manufactures, markets, distributes, and sells biopharmaceutical products worldwide. And despite the substantial near-term growth and cash windfalls from its COVID-19 vaccine and treatments, Pfizer's drug pipeline is still improving with several successful recent drug launches. But if we take a look at how Pfizer has performed year to date, they are down 24% and has followed the S&P 500 down. Over the last year though, they are up 3.7%, so it would have been a pretty okay investment in that regard. With that said, let's take a closer look at Pfizer, where we will first look at some of the fundamentals of the company, then use our 5 valuation models. If you want to get these for yourself, they are all available at my Patreon in the description below. Pfizer is trading at a PE non-GAAP forward ratio of 6.6, which is almost 45% below the 5-year average. So it's a huge discount right about now. And if we scroll down to the price to book forward ratio, it's at 2.43, around 30% below the 5-year average. If we take a look at the dividend stats, they do have a yield of 3.73%, payout ratio of 26%, 5-year growth rate of just under 6%, and a dividend growth of 11 years. If we jump into the financial statements, you can see here that the revenue is going up, and that is what we like to see. Obviously, a lot of this is due to the COVID-19 vaccines and treatments, but still they are generating a lot of revenue. Scrolling down to the net income, you can also see here that they are growing their net income from 21 billion in 17 to 29 billion over the last 12 months. Jumping into the cash flow statement, you can see cash from operations also rising, while the capital expenditures are pretty stagnant, I would say. It's only gone up around 1 billion from 1.9 here to almost 3 billion over the last 12 months. So they are generating a lot of cash without spending a lot of money to do so. If we take a look at the balance sheet, where were some of the numbers here we will use in a discounted cash flow analysis later, you can see the total cash and short-term investments are around 33 billion at the current time. And if we scroll down, you can also see that the debt is around 40 billion, but the net debt is thus 7 billion. So they really want to keep the debt. Maybe it's a very attractive price or whatever. If they wanted, they could almost pay out all of it right now if they so wanted. Also looking in here, we can see the total shares out on filing date have risen a bit. They actually bought back a lot of stock back in 18-19 and then they issued more shares. So this is definitely something you would look into why that is. That was how some of the numbers behind look, but let's take a closer look at the intrinsic value to get an idea whether or not the stock is over or undervalued. It's important not to skip ahead in this part, as I will share the assumptions I'm making from a valuation. So the first one we have here is Graham's revised valuation model, and you can see the growth rate from Yahoo analysts is expected to be at a negative 1.8. So I have copied that in because the fact that there has been a big windfall for them in terms of the COVID-19 vaccine, so I expect that the growth will not be able to keep up. We also put in the current yield of the AAA corporate bonds, which at the current time of recording is 4.59, and that gets us an intrinsic value of $25 per share. If we jump into the discounted cash flow model, you can see we do take the free cash flow from all the years. We then project it into the future with an applied growth rate. We discount it back to present value, add it all together, add it with the cash and the total debt, and thus we can find a fair value per share. Even though they do have an average growth rate of 14%, you can see from the graph here that a lot of it is coming from the last couple of years, which again is due to COVID-19 vaccines. So I have applied a very conservative 0% growth rate. If we use a discount rate of 9%, sum everything together, we do get a fair value of $66 per share. The next model is the dividend discount model, where we take the dividend payout from the year now and the previous years. We then apply a growth rate and we can then calculate back using the weighted average cost of capital to an intrinsic value. Even though the growth rate have been a bit higher, I actually took a bit conservative growth rate of 3% more in line with the current year because I think the economic macro environment right now doesn't necessarily cater to a big increase. And that gives us an intrinsic value of just below $50. The next one is the multiples valuation, where we do take the earnings per share and then we multiply it by the average PE of the peers to Pfizer. And in this case, we will get a stock price of $128. The last one is the free cash flow valuation, where we do take the price to free cash flow ratio multiplied by the free cash flow per share and thus get an intrinsic value. And in this case, we get $54. Before we get into the summary, if you have come so far, thank you so much for watching this video and please like the video and subscribe to support the channel. And as we can see here in the summary, we do have our 5 valuation models: the Graham's valuation model, discounted cash flow, dividend discount, multiples, and the free cash flow. And the average intrinsic value of these 5 models is $64. At Pfizer's current price of $42, there's already an average current discount of 33%. That means that if we apply a very high margin of safety of, let's say, 40%, the acceptable buy price is around 38. So that means that if we do take a margin of safety of 35%, that is actually the acceptable buy price is pretty close to the current price right now, meaning that there is a margin of safety of 35% at the current time if you do believe the fundamentals and the assumptions that I've made. So let me know down in the comments if this is a company you are interested in, and if not, I'd love to hear as well. Thanks again so much for watching.